Before we begin, don't forget to like, subscribe, and follow Insight Global, your source for powerful insights on global economics, politics, and the shifting balance of power. Cracks in the global financial system are widening, and this time, the world isn't looking away. China, once content to maneuver quietly behind the scenes, is now stepping into the spotlight. Every move it makes appears calculated, deliberate, and aimed straight at the heart of American financial supremacy. For nearly a century, Washington has operated on a simple assumption that the US dollar would remain the unchallenged foundation of global trade, investment, and security. But that sense of invincibility is fading. Beijing is systematically reducing its holdings of US Treasuries, accumulating enormous gold reserves, and forming deep economic alliances with countries frustrated by decades of American financial dominance. These actions are not hypothetical plans on paper. They're already transforming the global monetary landscape. Inside Washington, policymakers are quietly panicking, trying to understand the scale of the shift. Investors are quietly repositioning their capital, while ordinary citizens remain largely unaware that the global financial order is being rewritten, right now, in real time. Every move China makes reverberates across global stock markets, corporate boardrooms, and household budgets. From the cost of mortgages to retirement funds, from consumer prices to job markets, the effects are already being felt. And yet, many still treat this as another trade disagreement. It's not. This is a struggle for the future of financial power, and, for now, the momentum is on China's side. Let's look at the data. Over the past several years, China has been steadily unwinding its exposure to U.S. debt. In July, its holdings of U.S. Treasuries fell to around $730 billion, down $26 billion in a single month, the lowest level since 2009. For comparison, in 2013, China held nearly $1.3 trillion. In just a decade, its holdings have almost been cut in half. Such decisions are not impulsive, they are the result of long-term strategy. U.S. Treasuries, the backbone of America's financial system, fund the government's public spending and serve as the ultimate symbol of the dollar's global dominance. But this dominance relies heavily on continuous demand from foreign buyers. When major holders like China, Japan, and Gulf nations begin to sell, confidence in the U.S. financial structure starts to erode. And the timing couldn't be worse for Washington. U.S. public debt has already surpassed $37 trillion, growing every single day. Servicing this enormous debt requires an endless stream of global capital. But as foreign investors retreat, the U.S. becomes increasingly dependent on domestic institutions, banks and, ultimately, the Federal Reserve, to fill the gap. This self-financing dynamic creates a dangerous cycle: higher interest rates, rising inflationary pressures, and a weakening dollar. If foreign demand continues to decline, the question becomes urgent: who will fund America's debt? And if this gap cannot be filled, how long can the U.S. continue borrowing at this pace before the system begins to collapse under its own weight? This is not just an issue for economists. It directly affects every American household. Mortgage rates, consumer prices, retirement savings, all are intertwined with this evolving crisis. But why is China taking this path? The answer lies in security and strategy, not short-term profit. Chinese leaders have long warned that the dollar is more than a currency, it's a geopolitical weapon. That warning became reality in 2022, when Washington froze Russia's foreign reserves following the invasion of Ukraine. In a matter of days, hundreds of billions of dollars that Moscow believed were secure became completely inaccessible. For Beijing, this was a wake-up call. If the U.S. could do this to Russia, what would stop it from doing the same to China, especially in the event of a conflict over Taiwan? With nearly $1 trillion in U.S.-denominated assets at stake, the risk was simply too great. China's response has been measured but relentless. It began gradually selling U.S. Treasuries, redirecting its reserves into safer, more independent assets. Gold has become the centerpiece of this new strategy, a timeless store of value immune to sanctions, freezes, or political manipulation. Unlike dollar-based assets, gold cannot be blocked or controlled by any government. In addition, China has diversified its holdings into other major currencies, the euro, pound sterling, and Swiss franc, all of which are stable yet less vulnerable to Washington's political influence. These shifts are not random. They are part of a broader vision to build a financial safety net beyond the reach of U.S. power. For the United States, this shift could not come at a more fragile moment. Treasury auctions are struggling to attract buyers, forcing the government to offer higher yields just to keep investors interested. Inflation remains above the Federal Reserve's comfort zone. And the once strong U.S. job market is showing signs of fatigue. In August, the U.S. economy added only 22,000 jobs, pushing unemployment to 4.3%, the highest level since 2021. Major sectors, manufacturing, construction, professional services, are already cutting back. The economic slowdown is not theoretical anymore, it's measurable, visible, and spreading. Top financial executives have begun voicing their alarm. Larry Fink, CEO of BlackRock, has openly said the economy is weakening, before our eyes, while Jamie Dimon of J.P. Morgan Chase warned of a 50-50 chance of recession, highlighting vulnerabilities in private credit markets where excessive debt could trigger instability. The data backs them up. The U.S. economy unexpectedly contracted by 0.3% in the first quarter of 2025, the first negative growth since 2022. Meanwhile, the OECD forecasts that U.S. growth will slow further to 1.8% in 2025 and 1.5% in 2026, blaming tariffs, weak global demand, and tighter financial conditions. Yet, on the surface, everything seems fine. Wall Street continues to set record highs. The S&P 500 has broken 25 records in just 3 months, with double-digit annual returns. But beneath the celebration lies an uncomfortable truth. The market's optimism is built on the assumption that the Federal Reserve will soon cut interest rates. If inflation refuses to fall, if layoffs accelerate, or if corporate profits shrink, this fragile optimism could shatter overnight. The disconnect between Wall Street's euphoria and Main Street's struggles is growing more obvious by the day. Meanwhile, China is quietly repositioning its financial influence toward Europe. The European Union remains China's largest trading partner, with trade reaching nearly €860 billion in 2023. By holding more euros in its reserves, Beijing reduces its dependence on the dollar while deepening ties with a stable, large-scale financial system. The United Kingdom, despite Brexit, continues to serve as a critical financial bridge. The London Stock Exchange recently expanded the Shanghai-London Stock Connect program, allowing Chinese companies direct access to UK capital markets. For Beijing, the pound may be a smaller portion of its reserves, but it adds valuable diversity and another link to Western finance. And then there's Switzerland, whose reputation for stability far exceeds its size. The Swiss franc remains a global safe haven currency. Even in 2024, when it hit multi-year lows, international capital continued flowing into Swiss assets. The reason? A cautious central bank, a neutral political stance, and one of the most trusted financial systems in the world. For China, investing in francs isn't about chasing profits, it's about protection. Diversifying into euros, pounds, and francs sends a clear message to the world. The dollar is no longer the only dependable store of value. This shift in perception might ultimately prove more powerful than the flow of money itself. Once other countries start to believe the dollar can be replaced, the old financial order will begin to crumble. Confidence, not policy, is what sustains currency dominance, and that confidence is already leaking. Auction after auction, signal after signal, the foundation of U.S. financial strength is showing visible cracks. And history teaches us one unshakable truth: global power doesn't wait for permission to shift. If America's financial pillars are trembling, the question becomes not if, but when a new global reserve system will emerge, and who will lead it. Stay tuned, because the next chapter of this story may unfold far faster than anyone expects. If you enjoyed this in-depth analysis, make sure to like, subscribe, and follow Insight Global for more deep dives into world economics, geopolitics, and the forces reshaping our future.